This presentation covers the management accounting technique of activity-based costing. Traditionally, manufacturing was labour-intensive. It made sense, therefore, to trace overheads to products, or to absorb, based on the number of labour hours worked, or the number of units produced. Absorption costing was used for this. Activity-based costing is an alternative to absorption costing. It recognises that today, manufacturing is no longer labour-intensive and looks for new ways to trace overheads to products. Before delving into activity-based costing in more detail, it is important to put this treatment of overheads into some context in terms of how they were traditionally treated under absorption costing. Company A manufactures two products, Product P and Product Q. Company A is trying to calculate the cost per unit of production of Product P using an absorption costing system. Material and labour are direct costs. We can link these costs to each individual unit of production. So the material cost is 50 per unit and the labour cost is 40 per unit for Product P. Indirect costs are also known as overheads. These costs cannot be linked directly to each unit of production, so we must find a suitable method of allocating the overhead amongst the units. Traditionally, under absorption costing, the overhead per unit is calculated based on the overhead absorption rate. The overhead absorption rate uses one basis of absorption. In other words, one way to divide the overhead amongst the units. So, total overhead is divided by the total number of labour hours, or maybe the total number of units produced. Say, for example, total company overhead equaled 3,000, and it was decided to absorb overhead based on the number of units produced. Let's say 70 units of product P, as well as 30 units of product Q were produced. In other words, 100 units in total. Then the overhead absorption rate per unit of each product would be $30, being 3,000 of overhead divided by 100 units. Total cost per unit of P now equals $120. Company A may have decided to absorb its overhead based on the number of labour hours worked. So if, for example, 250 labour hours had been worked in the period, then the overhead would be absorbed at the rate of $12 per labour hour. If we assume that each unit of product P required 2 labour hours, then the overhead absorbed by each unit would be $24, being 2 hours multiplied by $12 per hour. Total cost of unit of product P now equals $114. Under absorption costing, Company A could also have absorbed its overhead using other bases of absorption, such as number of machine hours worked, or using the prime cost of each unit as a basis of absorption. In the modern environment, activity-based costing recognizes that overheads are no longer driven by manufacturing activities only, or the number of units produced. Overheads are incurred as a result of product research and development, design, technology, after-sales service, for example, all of which focus on improving the quality of the product. Different products consume these company resources in different ways, thus incurring overheads at a different rate. So, bearing this in mind, activity-based costing looks for a new way to trace overheads to products. In other words, a new way to absorb. Material and labour are direct costs in our example. We can link these costs to each individual unit of production. There is no difference in how we treat direct costs under absorption costing and activity-based costing. So, the material cost of $50 per unit and the labour cost of $40 per unit for product P are the same under activity-based costing as they are under absorption costing. However, under activity-based costing, the overhead cost per unit, and so the total cost per unit, will differ to the $30 and $24 we have calculated using absorption costing. This is the focus of this presentation. Activity-based costing will perform an alternative calculation to derive the overhead cost per unit, resulting in a more accurate reflection of the overhead attributable to each product and thus a more accurate product cost. There are 4 main steps involved in calculating the overhead cost per unit under activity-based costing. Step 1. Separate the overheads into cost pools. Step 2. Identify the cost driver for each cost pool. Step 3. Calculate the overhead absorption rate for each cost driver. And Step 4. Use the overhead absorption rate to absorb costs from each cost pool into the units of production. This calculates the overhead cost per unit. Let's apply these steps to a new comprehensive example. Costing company produces 2 products, product A and product B. The budgeted cost information for each product is as follows. The direct material costs are given as 35 for product A and 45 for product B. Similarly, the direct labour costs are given as 25 for product A and 20 for product B. The production overheads are broken into different types or cost pools. The cost pools are machine costs, setup costs, and quality inspection costs. The total overhead per each cost pool is 300,000, 700,000 and 250,000 respectively. Total production overhead amounts to 1.25 million. For each of product A and product B, we are also told the number of production units, the number of production runs, the number of inspections, and the machine hours spent producing these units. There are 2 requirements. Number 1, calculate the cost of each unit of product A and product B under absorption costing, using the number of units as a basis of absorption. And secondly, calculate the cost of each unit of product A and product B using an activity-based costing system. Let's calculate the cost per unit under absorption costing. The material and labour costs for both product A, 35 and 25, and product B, 45 and 20, have been given to us in the question. These are the direct costs. The overhead totals 1.25 million. Using absorption costing, the total overhead will be absorbed on the basis of the total number of units produced by the company. Product A has 25,000 units of production, and product B has 50,000 units of production, meaning a total number of units equaling 75,000. So, the overhead absorption rate is $16.67 per unit of production, being the overhead of 1.25 million divided by 75,000 units. If we add the overhead cost per unit to the material and labour cost, the total cost per unit of product A and B amounts to $76.67 and $81.67 respectively. We know that this is the cost per unit under absorption costing, or the traditional cost per unit, in which overheads are absorbed based on production volume, in this case the number of production units. Let's calculate the cost per unit using activity-based costing. As outlined above, a 4-step approach will be used to calculate the overhead cost per unit. Step 1 is to separate overheads into cost pools. This has been done for us in the question, in that the total company overhead of 1.25 million has been separated into 3 overhead types, or cost pools. The cost pools are machine costs of 300,000, setup costs of 700,000, and quality inspection costs of 250,000. Step 2 is to identify the cost driver for each cost pool. Here we need to determine what is driving each of the 3 overhead types. The cost drivers are typically given in any activity-based costing scenario, and it is the job of the student to link the cost driver to the cost pool. So, the first cost pool, machine costs, is driven by machine time, or the number of machine hours. Setup costs are determined by the number of production runs, while quality inspection costs are driven by the number of inspections carried out. Step 3 requires us to calculate the overhead absorption rate for each cost driver. Now that we have linked the cost drivers to the cost pools, we can calculate the cost driver rate or overhead absorption rate. This is calculated as the overhead per cost pool divided by the cost driver incidence. So the machine overheads are 300,000. The number of machine hours, or cost driver incidence, is 100,000, being 50,000 hours for each of product A and product B. This produces a cost driver rate of $3 per machine hour, being the overhead of 300,000 divided by 100,000 hours. Thus, each machine hour used in the production of A or B will incur an overhead charge of $3. Similarly, setup costs total 700,000. The total number of production runs is 280, being 200 for product A and 80 for product B. Hence, the cost driver rate, or overhead absorption rate, is 2,500 per production run. The final cost pool is quality inspection costs, which total 250,000. The cost driver here is the number of inspections, which total 750, being 250 for product A and 500 for product B, resulting in a cost driver rate of $333.33 for every inspection. In step 4, we use the overhead absorption rate, as calculated above, to absorb costs from each cost pool into the units of production. This will calculate the overhead cost per unit. So, for product A, machine costs of 150,000 are absorbed, being 50,000 hours at $3 per hour. Setup costs of 500,000 are absorbed, being 200 production runs at 2,500 for each production run. And quality inspection overhead of 83,333 is absorbed, being 250 inspections at an overhead absorption rate of $333.33. Total overhead absorbed by product A equals 733,333. Similarly, for product B, machine costs of 150,000 are absorbed, 50,000 hours at $3 per hour. Setup costs of 200,000 are incurred, being 80 production runs at 2,500 per production run. And quality inspection overhead of 166,667 is absorbed, being 500 inspections at an overhead absorption rate of $333.33 per inspection. Total overhead absorbed by product B equals 516,667. Having calculated the total overhead attributable to product A and B, we can now generate the overhead for each unit of production. 25,000 units of product A have been produced, meaning an overhead per unit of $29.33. This is made up of the total overhead of 733,333 divided by the total A units of 25,000. Similarly, 50,000 units of product B have been produced, meaning an overhead per unit of $10.33. Finally, now that the overhead cost per unit has been calculated, we can add this to the direct material and labour costs to derive the cost per unit of production. This all means the total cost per unit of product A is $89.33, while the total cost per unit of product B is $75.33. Let's focus on the allocation of the overhead between the two products and understand how activity-based costing has split each overhead type between product A and product B. As discussed above, on a total basis, A has incurred more overhead than B. Both A and B have used the same number of machine hours, 50,000, meaning the same machine overhead is absorbed by each product, 150,000. Even though B has used twice the number of inspections than A, 500 compared to 250, thus incurring twice the amount of inspection overhead, Product A has used 200 production runs compared to B's 80 production runs. Given the significant overhead absorption rate of $2,500 per production run, Product A absorbs $500,000 of setup costs, compared to $200,000 for Product B. So, activity-based costing considers the activities that drive costs and traces overhead to products based on this. Essentially, the more activities, or the more use of company resources, then the greater the overhead absorbed. Overall, there's a different cost per unit for each product when comparing absorption costing and activity-based costing. Under activity-based costing, Product A cost per unit has increased from $76.67 to $89.33, while Product B has seen a decrease in the cost per unit from $81.67 to $75.33. Given the more precise allocation of overhead under activity-based costing, each unit has a more accurate cost. The cost per unit has knock-on implications for product pricing decisions and product viability. Ultimately, there are longer-term implications for the company's decision-making and planning. In the modern environment, overheads relate to product design and research, customer service, and other such product-sustaining activities. Absorbing overheads based on production volume is no longer as relevant as it once was in the past. This supports the use of activity-based costing in the modern environment, resulting in a more accurate reflection of the overhead attributable to each product and thus a more accurate product cost. Despite its perceived superiority, problems can arise when implementing an activity-based costing system. Activity-based costing is a more complex costing system. It may not be fully understood by many managers, and therefore not fully accepted as a means of cost control. Staff within an organization may be resistant to such change. At a minimum, activity-based costing training would be required, which would represent a cost to the company. Difficulty can arise in identifying appropriate cost drivers. It is not always easy to identify a single cost driver that is specific to a particular overhead. Indeed, this can be an arbitrary process. Activity-based costing relies upon detailed accounting records in which cost pools and cost drivers are identifiable. Compiling such records can be a time-consuming and costly exercise. Target costing is a market-driven approach to pricing that looks to calculate an acceptable level of costs based on a selling price that has been researched in the external market. Let's consider the steps involved for a typical manufacturing company in the target costing process. In a manufacturing company, target costing applies to a particular product. So we begin in step 1 by specifying a product that the company wishes to sell. This will involve an analysis of the market and a determination of what product features are of interest to customers. In step 2, the price at which the product will be sold is considered. This will be a market-driven price based on what a customer is willing to pay for the product or their perceived value of that product. This is referred to as the target price. The company then calculates the profit that is required from the sale of this product. This profit is usually determined by what the company investors may deem to be an acceptable return on their investment. This can be referred to as the required profit or the target profit. In step 4, we determine the target cost. This is calculated by subtracting the required profit, as we've discussed in step 3, from the product selling price, as we saw in step 2. The target cost represents the highest acceptable cost of the product. If the estimated costs of that same product are greater than the target cost, then a cost gap exists. This cost gap needs to be closed, meaning a review of the costs incurred during the product's design and production stages. It is important, however, that the quality of the product is not impaired as a result of any cost reductions. Finally, in step 6, if a cost gap still exists, the company could consider negotiating with customers, in order to determine whether the manufacture of the product proceeds. Let's see the target costing process in action by way of an example. Company A has calculated a selling price for a new product, product P, of $100. A profit margin of 30% is required to satisfy the company investors. The question is, calculate the target cost. We now know that the sales price minus the profit, or the required profit, is equal to the cost, or the target cost. Company A has established a selling price of $100. We can assume that significant market research has been undertaken to ensure that this product P is of interest to customers. Also, we can assume the price of $100 is competitive and has been set based on what a customer may be willing to pay for this product, as well as the desired share of the market sought by Company A. In other words, we can say that the $100 sales price is a target price. A profit margin is calculated based on what is an acceptable return to Company A's investors. A 30% required profit margin equates to a $30 profit based on product P's sales price of $100. Based on these numbers, we can derive the target cost of the new product. This is calculated by subtracting the required profit of $30 from the product selling price of $100. The target cost of $70 represents the highest acceptable cost to Company A of making product P. Now let's continue with the same scenario involving Company A. Company A calculates that material, labour and overhead costs associated with producing product P are $40, $25 and $13 respectively. Calculate any cost gap that may exist regarding product P. The total estimated cost of making product P amounts to 78, being the sum of 40, 25 and 13. This estimated cost of 78 exceeds the maximum allowable cost or target cost of $70 by $8. This $8 is referred to as a cost gap or a target gap. Company A must focus on reducing or eliminating the cost gap. In other words, the anticipated material, labour and overhead costs incurred during the design and production of product P must be revisited to see if any cost reductions can be made. It's important that in its effort to reduce costs, Company A does not sacrifice the quality of the product. Any impairment of quality could have a knock-on impact on customer demand and ultimately company profit. Value engineering is a term often associated with target costing at this stage of the process. Value engineering helps businesses achieve cost efficiencies and meet their cost and profitability targets. Attention therefore should be focused more on reducing the cost of product features perceived by the customer as non-value adding. To eliminate the cost gap, a company could consider alternative product designs. It can often be easier to reduce costs at the design stage of a product than during its production stage. If a company is looking for possible areas of cost reduction during the manufacturing or production stage, then the following may be considered. Can any of the materials be eliminated? Perhaps, for example, the product packaging could be reduced. Can an alternative, cheaper material be substituted into production? Care must be taken here that a cheaper material does not impact the quality of the product. Can the cost of labour be reduced? Maybe it is possible to use lower skilled labour, thus paying a reduced amount. Again, quality should not be compromised here. Staff morale could be improved, which might have positive implications for productivity. Automation. It may be possible to replace repetitive labour tasks with machinery. Over time, this could result in cost savings. Or perhaps the incidence of cost drivers could be reduced, thus reducing any overheads incurred during production. These are just some possible actions a manufacturing company could consider when looking to eliminate a cost gap. Note that it is not possible to close the cost gap by increasing the selling price or reducing the profit of the product. The sales price and the required profit have already been determined by reference to factors external to the company. Target costing is just as relevant to the service sector as it is to the manufacturing sector. However, problems can arise when trying to apply target costing in service industries. Unlike manufacturing, service industries have the following characteristics which can make target costing more difficult to implement. Spontaneity. Unlike manufactured goods, a service is consumed at the exact same time that it is produced or made available. Or in other words, the service does not exist until the point where it is experienced by the customer. Perishability. Because the service is consumed immediately, then it is perishable. Hence, unlike a manufactured good, a service cannot be stored or placed in inventory. Intangible. A service cannot be seen or touched, hence it is intangible. This obviously differs to a manufactured product, which has physical substance and can be seen and touched. Unique. As a service involves people and typically human interaction, then no two services can ever be seen to be homogeneous. While standardization of a service may be expected by the customer, this is often very difficult to provide. And finally, no transfer of ownership. Unlike manufactured goods, services do not result in the transfer of property. The purchase of a service only grants the customer access to or the right to use a facility. Traditional costing systems focus on costs incurred in the production stage only: material, labour, production overhead. Also, traditionally, costs are assessed on a periodic or financial year basis. In contrast, lifecycle costing considers all costs that will be incurred by a product from the design stage right through to its retirement. In other words, lifecycle costing focuses on pre-production, production, and post-production costs. So, by considering all of these costs, lifecycle costing captures a true picture of product cost and can be seen as a cost tracking system over the life of that product, with the aim of minimizing the cost and thus maximizing the return. The life cost of a product can be linked to the various stages of that product's life cycle. Generally, there are 5 main stages of a product's life cycle. Research and development. The costs incurred at this stage include market research, product design, product testing, and training of staff. Introduction. As the product is then introduced to the market, significant advertising costs might be incurred in addition to the production and distribution costs of that product. Growth. As the popularity of the product grows, production and warehousing costs also grow, and customer support costs increase. However, product unit costs may begin to fall as economies of scale are achieved. Maturity. Product sales are maximized at this point. Unit costs should now be low. Additional promotional costs may be necessary to maintain customer awareness of the product or brand. Customer service costs will most likely be significant at the maturity stage. Decline. In the decline stage, companies may incur promotional costs to prolong product sales. Decommissioning and product retirement costs will be maximized at this stage. Remember to assess the profitability of the product over its entire life, as opposed to over a particular year. The above costs associated with the life cycle of the product need to be understood. Let's see how the life cycle cost can be derived for a particular product. Company A will shortly launch a new product onto the market, product T. Market research costs of $800,000 and product design costs of $2.3 million will be incurred in year 1. These are pre-production costs. Budgeted units of production are 12,000 in year 2, 20,000 in year 3, and 7,000 in year 4. Advertising costs are budgeted to be 1.5 million in year 2, 2.1 million in year 3, and 400,000 in year 4. The manufacturing cost of each unit of production is 110, 95 and 115 in years 2, 3 and 4 respectively. Disposal costs of 300,000 are incurred in year 5. These are post-production costs. The requirement is to calculate the life cycle cost per unit of product T. The life cycle cost per unit is calculated by considering all costs incurred over the product's 5-year life cycle. Hence, we divide the total product costs by the total number of units in order to derive a unit cost. So, we add year 1 pre-production costs of market research and product design to the advertising and manufacturing costs incurred in years 2, 3 and 4. Note that the annual manufacturing costs need to be calculated. In year 2, for example, manufacturing costs total 1.32 million, being 12,000 units of production multiplied by a unit cost of $110. Similarly, manufacturing costs total 1.9 million in year 3 and 805,000 in year 4. Of course, as we're considering all life cycle costs, we also add the post-production disposal costs incurred in year 5. Life cycle costs of product T amount to $11.425 million. Budgeted units of production in years 2, 3 and 4 total 39,000 units. Hence, the life cycle cost per unit, calculated as total costs divided by total units, or 11.425 million divided by 39,000 units, is $292.95. There are obvious benefits available to a company engaging in life cycle costing. Given that life cycle costing captures all costs associated with a particular product, it generates a complete and more accurate product cost and a true picture of product profitability. A more accurate profit has, in turn, knock-on implications when considering the viability of the product, what price should be set, or how many units need to be sold in order to achieve break-even status. Ultimately, there are longer-term positive implications for the company's decision-making and planning.
In this session we are going to cover the topic of throughput accounting. We are going to discuss and apply the theory of constraints, calculate and interpret the throughput accounting ratio and suggest how this ratio could be improved, and we will also apply throughput accounting to a multi-product decision-making problem. Throughput accounting assumes that the only totally variable cost is materials, and that there is some element of fixed costs within labour and overheads, and as such only material costs are considered within the throughput calculation. The throughput figure is therefore simply sales revenue minus material costs. So clearly, in order to maximise throughput and therefore profit, we want to maximise revenues and minimise conversion and material costs. Let's start by looking at the theory of constraints. This theory was formulated by Goldratt and Cox in 1986. The principle is that a business wants to turn materials into sales as soon as possible, to maximise the cash generated from those sales, and as a result an even production flow is required to achieve this. Clearly, if we want to maximise profitability, we want to ensure that we maximise our output of all profitable products, but sometimes this is not possible, as there is a scarce resource or other factor that limits our output levels. We call this the constraint or bottleneck. The sorts of issues that might cause a bottleneck would be availability of material, unreliable suppliers, labour or machines, or a poor salesperson resulting in sales volumes being limited. If there is a bottleneck reducing output within the production process, we want to make sure that we don't produce higher output levels before the bottleneck than the bottleneck can cope with, as this will cause the levels of work in progress before the bottleneck to continually increase, hence the need for an even production flow. There are 5 main steps in the theory of constraints process. Step 1 is to identify the bottleneck or constraint. Step 2 is to decide the best means of exploiting the bottleneck. In other words, make sure that output is maximised at the bottleneck. Step 3 is to ensure that production up to the bottleneck is at the same rate as after the bottleneck, so that work in progress does not build up. Step 4 is to work out ways to elevate the bottleneck. This means working out ways of increasing the output at the bottleneck point so that total output can increase. And step 5 is to return to step 1. Eventually, by removing one bottleneck, another is likely to appear. So at this stage we would need to go back to step 1 and repeat these 5 steps. Once we know what the constraint or bottleneck is, we can use limiting factor analysis to determine which product or products should be produced to maximise throughput. The calculations are performed in much the same way as for regular limiting factor analysis, but rather than ranking the products based on contribution per limiting factor, we will now rank them based on throughput per bottleneck resource. The product with the highest throughput per bottleneck resource should be produced first, followed by the product with the next best throughput per bottleneck resource, and so on until the bottleneck has been utilised in full. For more information on limiting factor analysis, please see the video covering this topic. As the throughput calculations are almost identical to regular limiting factor analysis, I will not be covering a numerical example on this video. The video on limiting factor analysis should provide enough detail, but there are also some numerical examples within an article on throughput accounting on the ACCA website that help support this video. The throughput accounting ratio can help us to determine whether a particular product covers operating costs and therefore makes a profit, or if it does not cover the operating costs and therefore makes a loss. We can then use this information to determine which product or products should be made given the bottleneck. There are 2 other ratios that need to be calculated before we can calculate the throughput accounting ratio, or TPAR. The first is the one we would use to rank products using a limiting factor analysis approach, and that is to take throughput per unit and divide through by the time taken in the bottleneck resource. This gives us the return per factory hour for a given product. The second ratio is based on the entire factory and is used to find the cost per factory hour. This is calculated as the total factory cost divided by the total time available on the bottleneck resource. The throughput accounting ratio is then calculated as return per factory hour divided by cost per factory hour. If the throughput accounting ratio is greater than 1, then throughput is greater than operating costs, and a profit will be made. If the throughput accounting ratio is less than 1, then operating costs are higher than throughput and a loss is made. Clearly, where a loss is made, we would not want to make this product. Where more than one product has a throughput accounting ratio of greater than 1, then products would be ranked from the highest ratio to the lowest, and the production plan would be based on this ranking. Let's run through a quick example to demonstrate the throughput accounting ratio calculation. A business makes and sells a product that has a selling price of $8 per unit. The material cost per unit is $2.50. Monthly operating costs are $32,000, and there is a bottleneck in relation to machine hours. There are only 8,000 hours available each month, and it takes 1 hour to make each unit. Based on this data, we can calculate the throughput per unit to be $8 minus $2.50, giving us $5.50. The return per factory hour is therefore $5.50 divided by 1 hour, so $5.50 per hour. The cost per factory hour will be the monthly operating costs of $32,000 divided through by the total time available each month of 8,000 machine hours. So this will be a cost of $4 per hour. The throughput accounting ratio is therefore $5.50 divided by $4, giving us 1.375. As this is greater than 1, we will make a profit if we make this product. We could see this by simply looking at the respective return and cost per hour figures. The revenue is higher than the cost, so we must make a profit on this product. The ratio is important for ranking products in multi-product decision-making processes. Once we know the throughput accounting ratio for a product, we might want to think about how we can increase or improve the ratio for that product. We could do this by either increasing selling prices or reducing material costs to increase the throughput itself. This may of course result in a reduction in demand or us using a lower quality material, which would then result in higher levels of wastage and a lower output. We could also look to improve productivity and thereby reduce the time spent making each unit, and as a result we could make more units in the time available. To finish off, please be aware that there are a number of criticisms of the throughput accounting ratio. It only considers the short term when operating expenses are mainly fixed. It concentrates too much on materials, excluding other costs that might impact on the profitability of the products being produced based on the ranking approach discussed. And it is more difficult to apply in the longer term when labour costs are classed as a variable cost.
In recent years, there has been increased emphasis on the need for businesses to consider the environmental impact of decisions that they make. Organisations are beginning to recognise that awareness of the environment is not optional, but instead is important for long-term survival and growth. Indeed, environmental management accounting has become increasingly topical. There are increased legal and regulatory requirements relating to environmental management. Financial penalties exist for non-compliance. Ethically, companies should be seen to be aware and care about how their activities, such as manufacturing for example, impact the environment. There is increased need to manage the risk and potential impact of environmental disasters. In order to maintain a positive public image and a strong brand, companies need to demonstrate effective environmental management. Environmental costs are becoming increasingly significant, thus impacting a company's financial performance. Hence, for all of these reasons, organisations are becoming more cognizant of the environment and how it can impact on the success of their business. Environmental costs can generally be split into two categories. Internal costs. This refers to costs that directly impact on the profit or loss account of the company. Examples include water disposal and waste disposal costs, financial penalties or increased taxes paid due to poor environmental management record, costs incurred in upgrading production processes to ensure compliance with regulations, cost of securing a license or permit which allows the company to give off a certain level of carbon emissions. Also, external costs. These costs are not borne by the company, which is responsible for their origin, but instead the costs are imposed on society. Examples of such external costs can include carbon emissions, increased healthcare costs, possibly as a result of such carbon emissions, energy and water usage, deterioration of other natural resources such as wildlife or forests, for example, social welfare costs. In recent times, governments have been trying to transfer such costs to the companies responsible for generating them. In other words, trying to convert external costs to internal costs. This is usually achieved by way of imposing financial penalties or increasing taxes. Increased carbon emissions from a company's manufacturing plant, for example, may result in a corresponding increase in tax payable by that company. Also, given the need for a company to be aware of the environmental impact of its activities and the related broader implications for that company, as we have been discussing above, some organisations are voluntarily converting external costs to internal costs. Organisations are frequently unaware of the extent or types of environmental costs within their business. As a result, they struggle to properly account for environmental costs and to implement effective cost-saving programs. Some appropriate management accounting techniques have been put forward to identify, measure and reduce environmental costs. Remember to do so provides mutual benefit to both the company and the environment. Let's examine some of these techniques. Input-output analysis. The logic here is that all inputs to a process must be traced to outputs. This approach forces an organization to consider all outputs from a process, regardless of whether they result in a finished unit of production, scrap item that can be disposed of, wastage, or other. Thus, any waste or pollution can be tracked on both a physical and a cost basis. For example, say 100 kilograms of materials have been purchased and input into the production process. At the end of the production process, there are 90 kilograms of output or production. Hence, the 10 kilograms lost during production must be accounted for in some way. Perhaps 4 kilograms of this has been sold as scrap. 6 kilograms is classified as waste. By assessing the outputs in terms of both physical quantities and related monetary terms, the company is forced to focus on the environmental cost. Flow cost accounting. Flow cost accounting monitors the flow of material through a business in 3 categories of its organizational structure: the purchase of material, the production system and delivery to the customer, and disposal of waste. Flow cost accounting highlights material flows by examining the physical quantities involved, their costs and their value at each stage of the organization. Flow cost accounting aims to reduce the quantity of material at each stage. Not only should this reduce the company's carbon footprint, which will have a positive effect on the environment, but it should also reduce the company's costs over the long term. Activity-based costing. By identifying cost drivers, activity-based costing helps us to understand how costs arise, and so the company can focus on reducing these costs. Thus, activity-based costing principles can be used to identify drivers for environmental costs. This would involve a detailed analysis of the business processes. If, for example, it could be ascertained that the number of production runs was the dominant cost driver of a company's electrical costs, then the company could focus on reducing that number of production runs, thus reducing the electrical or environmental cost. Life cycle costing. Life cycle costing considers all costs over the life of a product: pre-production, production, post-production. Hence, by using life cycle costing, a cost incurred by the company can be more easily identified. Once identified, management can then focus on reducing such costs. Environmental costs can be identified and measured at each stage of the product's life cycle, from the design stage right through to its obsolescence. Key features of a company's environmental management accounting system might include some of the following. Ensure regulatory compliance. This might include monitoring waste levels to ensure they are not exceeded, or ensuring staff receive a standard level of training. A company may carry out internal audits to ensure it is compliant. The company should have an online environmental policy statement. The company's public relations department might have a defined set of environmental procedures. Realistic targets should be set to reduce carbon emissions and related environmental costs. Such targets should be part of a larger performance appraisal process. Budgeted environmental cost reduction targets should be compared to actual results. If targets are not met, then corrective action should be considered.